Alright, Professor Jim Schultz here from my Finance 670 class. I wanted to go ahead and do this cost of capital, little kind of brief introduction, this kind of YouTube lecture on what is cost of capital and how can we understand what it's trying to tell us, at a basic kind of fundamental level. So let's go ahead and get started. So the first thing you want to recognize, and something that you probably picked up on when we were going through the bond valuation section and the stock valuation section, is that when a company needs money, when a company needs capital, there are essentially two sources of funding for the company. They can either issue equity, which is the same thing as saying that they're going to sell stock to the public, or they could issue debt, which is the same thing as saying they are going to sell bonds to the public. The basic idea here is, as you learned in both of those individual sections, right? We had an individual section on bonds, we had an individual section on stocks. You learned that, hey, if I'm a bond investor, I have a required return on that investment, right? That's my yield to maturity. If I'm a stock investor, I have a required return on that investment. In other words, these investors are demanding a return on their investment, which makes perfect sense. This section, this cost of capital idea, is simply looking at these exact same two ideas, the required return for stocks and the required return for bonds, but now we're simply going to look at it from the viewpoint of the company. That's all it is. So the required return on stocks is the cost of equity to the company. In other words, that return that stock investors are demanding, the company is responsible for that, and it is a cost to them. That return that bond investors are demanding, the company is responsible for that, and it is a cost to them. Now, again, as has been the case with everything else, there's a lot more going on here behind the scenes that you guys will learn about in Finance 680. But this is a really, really good starting point. And so the cost of capital for the company, or it's most commonly referred to as the WACC, which stands for the weighted average cost of capital, that is simply the cost of equity and the cost of debt coming together to produce an overall average cost of capital for the company. Because the company is going to issue some stock and it's going to issue some bonds, right? It's going to have a mix of debt and equity in what is referred to as its capital structure. The company might be 30% equity and 70% debt. It might be 70% equity and 30% debt. It might be 100% equity and 0% debt, right? The combinations are essentially endless. But that's essentially what your WACC represents. It represents, when you take into account those different combinations, what is the overall cost of capital to the company? Okay? Now this guy right down here, this is the WACC equation. And so this is really, I kind of blew through this very quickly because I really wanted to get down to here. We'll probably knock this out in just a one-part series because it's pretty quick, it's pretty brief. This is what I really want you guys to be able to do coming out of Finance 670. I really just want you guys to be able to complete very basic, very standard WACC calculations. Okay? So here's basically what all these variables mean, and then again I will have a video going through a couple of WACC problems. E over V. What is E over V? Well, E represents the market value of equity in the company's capital structure. V represents the total market value for the firm. So say, for example, the company was worth $100 and the equity in the company was worth $30, right? That would mean that you'd have 30 divided by 100, or 30%. 30% of your capital structure would be coming from equity. Okay, so that is what the E over V ratio represents. It basically represents the percentage of your capital structure that is originating from equity. R subscript E, this RE guy right here, that is your cost of equity. Okay? So how do you solve for the cost of equity? It's very simple. You just solve for the required return on the stock, right? So you guys learned about that constant growth model with, P0 equals D1 over R minus G. That R is the required return on the stock. So in turn, it is the cost of equity on the stock. Now there is actually a second way to solve for cost of equity, but you guys will learn. You guys will see that in Finance 680. Now D over V is going to have a very similar interpretation as E over V had. So V is still the same V, it's still the market value of the firm, but now D, now surprisingly, is the market value of the debt in the firm. So in our example here, we had $30 of equity, $100 for the whole firm, equal the whole firm, right? So this would be 70 divided by 100, which would be 70%. So this guy right here represents the weight of debt in the capital structure. R sub D is nothing more than the required return on the debt, or the yield to maturity on that debt, because it is the cost of debt for the company. So this R sub D, that is the cost of debt for the company. You would simply be solving for the yield to maturity on the bonds, or you would be solving for the I that is in the time value of money equation. Now this 1 minus T, I'll explain a lot about this in Finance 680, but this T sub C, that is the corporate tax rate for the company. So if the corporate tax rate for the company was 30%, for example, then 1 minus 0.3 here would yield 0.7, right? And so you might be wondering, well, why is that even there? I will explain that in painstaking detail when I see you guys again in Finance 680. So that is it for a cost of capital overview. And again, I'm going to have a video going through a couple of WACC problems to get you guys going.